Okay, everyone, I know we still have people signing on, which is great, but in the interest of time, because we have a very full presentation from Craig and Michael, we're going to get started. So, wait a minute. Good morning again. My name is Erica Morin, and I'm the Manager of Training and Member Services at MSIC. Today's webinar is a full circle economic outlook as we are now just over a year following the onset of the COVID-19 pandemic in the US. A year later, we have seen the rollout of several vaccines. Some of us here today may be fully vaccinated or even halfway there. And we also saw the distribution of economic impact payments in the US to help people during the pandemic. And so while many of us are still working remotely, and the nation continues to wear masks and social distance, there has been progress for better or for worse. And this is why we're so pleased to have back with us today Vining Sparks Chief Economist Craig Dismuke and Senior Vice President Michael Erhardt to give us detailed insight with what has happened, where we are now, and what's ahead with the economy and with credit unions. Following Craig and Michael's presentation, we will have a question and answer sessions. So please submit your questions at any time during the presentation. You can do that using the chat box or the Q&A box found in the lower right-hand corner of your screen. Let me now introduce to you Craig Dismuke. Craig is Executive Vice President and Chief Economist for Vining Sparks and responsible for the projection and publication of Vining Sparks' economic and interest rate forecasts. He publishes research articles for Vining Sparks as well as other national publications, and often speaks at industry conferences on the health of the U.S. economy and expectations for interest rates. Craig is a frequent guest on CNBC, Fox Business, and Bloomberg TV, and is often quoted in the financial news. Craig, great to see you and have you here again today with us. The last time we had you here was just about 6 months ago. That was in September, which seems like both yesterday and a lifetime ago. And so we are anxious to hear what you have to share with us today.
Well, thanks, Erica. It is a lifetime ago from an economic perspective. The situation today is much different than it was 6 months ago, certainly much different than it was 12 months ago. But what I want to walk through this morning is how things are different today. Certainly, the subtitle of the presentation is Faster Vaccinations, Additional Stimulus, and a more rapid recovery. And there really was a sea change in the first quarter in the outlook in the vaccine, or sorry, in the pandemic situation. And so I want to highlight that, illustrate this sea change as it played out in the markets, and then look at a couple of economic indicators, and then talk about the outlook, our outlook for growth, and then spend a few minutes on inflation, since that's become a concern. Certainly it wasn't a concern 6 months ago, but today it's more of a concern. I'm not going to go through all of the details on this. This chart just shows the 10-year Treasury yield over the first quarter. You can see it was up 80 basis points for the quarter. During that time, there were a variety of events that occurred. Number one, the decline in cases, but really a big change in the fiscal policy outlook. And I've highlighted in green here, in the lighter green boxes, the events which really changed the fiscal landscape. The first were those Georgia Senate runoffs. I think the expectation going into the quarter was that Republicans would hold at least one of those and maybe both, and would retain their majority in the Senate. Instead, Democrats won both of those, and so now you have Democratic control of the White House, the House, and then the Senate being 50-50, with the White House breaking the tie, obviously. So Democrats controlling both chambers. Pretty quickly, a small stimulus plan, or a smaller stimulus plan, wouldn't be small by historical standards, but a stimulus plan that was in discussion was scrapped for a larger one. A $2 trillion stimulus ended up being $1.9 trillion plan. That was passed, as you can see, over in early March. The Senate passed the $1.9 trillion stimulus bill. It was quickly signed into law. And that really, in combination with the other factors that were ongoing, changed the outlook for the economic recovery as well as fiscal policy going forward. In addition to that, the president outlined another spending plan, an infrastructure plan, a variety of I'll highlight that in just a minute, but I think the overall outlook is A, we have more stimulus in the short term, and B, there will be more spending over the medium term. The virus situation turned notably better over the course of the first quarter. The number of cases, which is shown here in the dark blue line, peaks January 11th. That's the 7-day average. Deaths peaked on January the 13th. The cases peaked at over 250,000 per day. Today, they're down to around 70,000 per day, so dramatically lower than what it was. Deaths peaked at around 3,500 per day. Those are now down to 1,000 per day. Obviously, the situation is still concerning, but it's very different than it was in December and the beginning of January. As that has occurred, vaccinations began rolling out at the end of December. They really ramped up in the first quarter, and as of year end, there were 3.5 million people, or 3.5 million vaccines that have been administered. As of the end of the first quarter, that number was up to 150 million vaccinations that have been administered. Today, it's almost 170 million. So really very rapid vaccination process, more rapid than we expected. This data shows on the bottom, it shows the percentage of the population over 18 that's received at least one vaccine dose. This is from the Census Bureau, and this is from March the 16th. So it's dated. That pulse survey that they do comes out with a bit of a lag. We'll actually be looking to update that this week. But as of March 16th, you can see the percent of population from each state that has already received at least one vaccine dose. Massachusetts is there a little bit towards the left of middle. Currently 37%, or as of March 16th, 37% of the population had received at least one vaccine dose. And then you can see in the pie chart, the first pie chart, that currently, or as of March 16th, 70% of people over the age of 65 had received at least one dose. So I'd say a way to qualify this is that the most vulnerable part of the population has been vaccinated. And so that is positive news and continues to increase. At the top, you can see the vaccine reluctance. So people who say they probably or definitely will not take a vaccine. It varies by state. As you can imagine, everything that relates to this virus, including this, has a big political component to it. In the state of Massachusetts, for example, there are about 7% of people who say that they will not, or probably or definitely will not take a vaccine. So that you can see the difference between the dark blue bar and the light blue bar. That's the gap that we still have to cover. But again, we're covering it at a very rapid rate. Over on the right-hand side, you can see in the pie chart, you can see the total number of people who have said they will not, or definitely or probably will not take a vaccine. That's 17.2% as of March 16th. That's down from 21% in January. So you're seeing that vaccine reluctance drop a little bit. And I think the bottom line is, even if all of these people who say they will not, definitely or probably will not get a vaccine, were not to get one, you could still get to around 80% of the population vaccinated, which is sufficient for what has been, what epidemiologists and doctors have cited as being the level needed for herd immunity. So even with the vaccine reluctance that's in place, I think we'll be at a place pretty quickly where there will be sufficient immunity in the population to dramatically change the health outcomes. The situation is different in different countries. In the US and the UK, you can see on the left-hand side the daily rate of vaccination, and that's per capita. You can compare that to the European countries down at in the bars that are lower. It's running about double in the US and the UK versus those Eurozone countries. Over on the right-hand side, you can see total vaccinations as a percent of the population and again, this isn't the percentage of people vaccinated. This is just total vaccinated, total vaccines administered divided by population. But again, in the US, it's almost 60%. This is more current data versus in the Eurozone countries, it's less than 20%. So real challenges rolling out the vaccine in the Eurozone, and that's creating a two-speed recovery from a I guess from a continental standpoint, US versus Europe. In Europe, they're still really struggling, and that's likely to weigh on the global rate of recovery. One of the things you'll see in our forecast is that we expect imports to start to pick back up, but we expect that to be delayed by a quarter or two, specifically because of this. I want to turn now to the economic situation. As I mentioned earlier, the American Rescue Plan was passed March 11th. That was a $1.9 trillion plan. Just want to highlight a couple of things about it. Number one, coming into the quarter, we thought there might be $500 billion to $1 trillion in additional stimulus. But obviously, once those election results came in, the Democrats shifted to a larger stimulus package that included $410 billion in direct payments, a larger, about 33% larger program than in the CARES Act as far as direct payments go. It also extended those unemployment insurance benefits. It provided $360 billion for state and local governments, helping to shore up the challenges they faced from a revenue standpoint over and from a healthcare standpoint over the past year. So that was much larger than expected. In addition, as I mentioned, President Biden proposed the first part of his Build Back Better plan, which is expected to be $4 to $5 trillion in spending. The first part of this plan was the American Jobs Plan. That was a $2.25 trillion spending plan. You can see here some of the proposals that are included in that. It also increased the called for increasing the corporate tax rate to 28%. You can see in this chart the current U.S. tax rate is 25.8%. That's the effective tax rate, including national and subnational rates. Under the proposal, it would take the U.S. to 32.3, which would put it at the highest of the OECD countries. That is according to the Tax Foundation analysis of it. One thing to note here is Senator Manchin from West Virginia said that on the proposal to raise the corporate rate, that he said it's basically not going to end up that way, raising it to 28%. And he said there are several Democrats that feel strongly about that. On the scope of the spending, he said that he prefers a tighter focus on infrastructure rather than some of the ancillary items that are included here. So we'll see. The Democrats obviously have to keep all 50 on board to get this passed, unless they can appeal to moderate Republicans. And so we expect the eventual plan to be something smaller than this. We're not sure what it'll look like on the corporate tax rate side. We do expect corporate tax rates to be higher. We don't know if it'll be 25% or 28%, starting to lean towards 25%. As far as the economic data trends, you can see that they're improving. We're seeing some of this, the new data that we started tracking during the pandemic has started to turn higher. Restaurant reservations really running up since the end of January. TSA traveler throughput accelerating since the end of January. And so as those vaccinations are rolling out, I think more and more people feel comfortable getting out. Retail foot traffic, feel comfortable getting out, going about not business as usual, but at least getting back into some more regular activities. So that is positive news. We continue to track that. The labor market continues to show a lot of damage. On the left-hand side, we've included initial jobless claims. On the right-hand side, continuing jobless claims. Initial jobless claims are currently, when you include both programs, the traditional state-level benefits along with the pandemic program. And the pandemic program, I believe we discussed this 6 months ago, but that just broadens those who are eligible for benefits. It also extends the length of payments, but that's on the continuing claims side. But when you combine those two, initial jobless claims are 896,000. Just for context, the highest ever on record prior to the coronavirus was 695,000. So we're still above, on a weekly basis, we still are above the highest ever prior to the pandemic. So you can see that claims remain elevated, although they have improved. On the continuing claims side, still totaling 18.2 million, so still a large number of persons that are receiving some type of unemployment assistance, and certainly higher than anything we've seen in history. So the labor market continues to be damaged by the situation. One thing I would highlight, though, and this is an interesting nuance. claims are exactly that. They're jobless claims. They're not necessarily what is actually paid out. And on the left-hand side, you can see here in the in the gray line, the number of jobless claims filed during a 1-month period. As of February, it was 4.94 million new claims were filed during that month. You can also see in the dark blue line, that's the number of first payments made. So that's a report from the Department of Labor. It's released with a big lag. So the most recent report is February, that came out last week. And so we don't tend to report on it because it's so lagged. We are reporting on it now because of the difference between those two and how they've really broken from their historical correlation. Over on the right-hand side, you can see that first payments made as a percentage of total claims filed during a month has historically run around 45%. Today, that number is down to 16%. So it looks like there are a lot of new claims that are being made that are not being approved. And so we would say that there are aspirational claims, the people that are hoping that they will be able to receive benefits, but they have not been approved. So the bottom line is the jobless claims numbers may not be telling us a real reliable picture of how strong the labor market is right now. There is also very different, the geographic disparity is significant. You can see on the left-hand side, and this is continuing claims. So these are people who have been approved for claims already. The percentage of the population that is receiving some type of claim in New York is almost 13%. You can see in Massachusetts, it's almost 10%. California, almost 9%. You can compare that to the states on the right-hand side, Utah, Florida, South Dakota, where claims are below 1% of the total population, of the 18-plus population. And you see it's just very different geographically. I think a lot of this has to do, especially in New York, Massachusetts, Connecticut, some of the states in the Northeast, they were hit very hard by the virus initially. There is a very much a reluctance to get back to business as usual quickly because they saw a lot of damage initially. And so I think that's part of this. A lot of it has to do with the political leadership of the state. When we correlate this with governance by political party, there is certainly a correlation there, but there is definitely a geographic disparity in the rates of recovery that we're seeing in the labor market as well as in business reopenings, et cetera. Just one more item on jobs. There are currently 8.4 million payrolls that are still missing that have not been recovered yet. You can see on the left-hand side, the biggest sector for that is the leisure sector, with over 3 million payrolls still missing. Inside of the leisure sector, 1.5 million of those are restaurant workers. You have people that are in hospitality, et cetera, that represent a big portion of that. And those are jobs that we think could come back pretty quickly. So once travel resumes, we expect that those jobs have fairly low barriers to re-entry. This isn't the same as the financial crisis, where people were out of work for 12 months and they started to lose skills that enabled them to be employable. We think that the situation today is different, and these are jobs that are, they're lower income, which obviously that their lower income persons have been hurt more disproportionately during this pandemic. And so that's obviously a concern. But on the flip side, we think that there are jobs that could be recovered fairly quickly once things reopen. On the right-hand side, you can see and if you notice on the left-hand side, the blue and the gold lines, those are education and then government. Within those categories over on the right-hand side, you can see that a lot of those jobs that are still missing are in education. So as schools have shut down, they've lost a lot of payrolls. And so there are currently 1.5 million educators that are not on payrolls that were prior to the virus. So again, as schools reopen, we expect those are jobs that could be recovered fairly quickly. So we're optimistic that even with 8.4 million payroll still missing, a lot of those are ones that could come back fairly quickly. Despite the hole in the labor market, the interesting trend, we discussed this 6 months ago, but the interesting trend has been that income has not declined. Overall income has not declined. Certainly it has for certain people, but it hasn't broadly for the nation as a whole. Personal income has not declined. And you can see on the left, employment income dropped You can see the lighter blue line that shows, or the almost grayish line that shows what it would have been projected based on the 5-year growth trend. And you can see what actually happened. And then you can see down in the green, you can see income from non-employment sources. And you see how much it spiked. Those were the direct payments that were sent out. This does not include the American Recovery Plan at this point. This only includes the CARES Act and then the stimulus package that was passed in December. Over on the right-hand side, you can see when we combine these together, not the change in employment income, the decline in employment income. This is cumulative. So through February, it was down $600 billion. But non-employment income, so these transfers, these increased unemployment benefits, et cetera, they were up over $1 trillion. And so total personal income, when you combine all of those together, is shown in the bright blue line, and that's actually up over $400 billion. So income has not been affected. The bridge that policymakers have built has been sufficient to keep incomes buffeted through this. On the left-hand side, you can see total personal income. Again, it's actually been higher than what was projected. Personal spending, however, has been lower. So people haven't been able to spend, they haven't been able to go on vacation, things of that nature. And so personal income has declined. And again, taking the same idea, moving it over to the chart on the right, when we combine those things together, total income is up, total spending is down. Combine those together and you see that there has been a accumulation of excess savings. Today, we estimate that that number is around $1.8 trillion. We don't expect all of that to be sitting in people's pocketbooks per se, just waiting for things to reopen. Some of that has been used to pay down debt. Some of it's been used for other things, investments, things of that nature. But we do expect that consumers are sitting on a pretty good amount of pent-up savings that once things reopen, they do plan to use. And so we expect that to really turbocharge this recovery. Now you add on the additional stimulus payments from the American Rescue Plan, and that number is going to swell even further. So with all of that being said, and I'm not going to go through all of the sectors for the sake of time this morning, but with that being said, our expectation is that the economic recovery is quite rapid. We did not expect this a year ago. We expected it to be slower. We were not anticipating the amount of stimulus that has been passed. We're not expecting vaccinations to roll out as fast as they have. But you can see by category how this economic cycle, how we expect it to compare to the average economic cycle. And we've used on the left-hand side, that's the average economic cycle. And we've used the 3 most recent recessions and subsequent recoveries for comparison. And then you can see where we are today on the right-hand side. And we expect that, and one thing I would highlight is that the average economic cycle over on the left-hand side looks at the recovery and expansion over a 6-year period. On the right-hand side, we have the same y-axis, so the same rates of recovery, and yet that's spread out over just a 3-year period, which we're currently 1 year into. So we expect this to be a very rapid recovery. If there are any questions about why we think certain sectors are going to expand by certain amounts, I'd be happy to take those after Michael's portion of the presentation. With the introduction, or with the election results, with the additional stimulus, with the expectations for more spending going forward, with the faster vaccinations, et cetera, with all the things we've just discussed, we now expect the recovery to really accelerate. We expect 7.7% growth in 21. We expect 4% growth in 2022. So a much stronger rate of recovery than we projected prior. So now I'm going to spend the last few minutes talking about inflation, and then I'll conclude with our expectations for rates based on all of this. On the left-hand side, inflation has not been an issue really for the past 12 years. Over the past 148 months, there have only been 13 months, I believe it is, 13 months where inflation, core PCE, has been at 2% or above. So inflation has missed the Fed's target on the low side for a long time. Now, on the right-hand side, you can see inflation expectations have risen very quickly, and really since the end of the year, since the end of 2020, 5-year inflation expectations are up 60 basis points since that time. They're now up to 258. They're the highest that they've been going back to 2006. So with this faster rate of recovery, now comes the concern that, well, maybe inflation is going to be a problem. And there's one technicality and then two issues I want to address as it relates to that. The technicality, yes, we do expect to see inflation higher. Part of the reason for that is because prices were so affected by the pandemic. You can see on the left-hand side these various components of CPI, which dropped substantially as we went into the pandemic. Airline prices, a great example of something that plummeted, down 25% very quickly. They're still down 25% from where they were prior to the virus. As travel starts to recover, we expect those to go back to where they were prior to the virus at the least. As that occurs, that's going to push in the CPI numbers higher, but it's something that we expect to be temporary. We don't expect that that's a true source of core inflation. We think that it's something that is recovery from the pandemic. On the right-hand side, you can see this play out with oil prices. Oil prices fell well, these are futures contracts, so it fell from $60 a barrel to actually minus $40 a barrel in April. And that was as the expectation for demand dropped precipitously. They have since recovered. Oil prices are now back to $60 a barrel. And in the area, the lighter blue area, you can see that oil prices are now up over 100% on a year-over-year basis. So oil prices are back to where they were, but on a year-over-year basis, they're up 100%. And so that gives you a good idea of the technicality, why we expect inflation numbers to be higher, because on a year-over-year basis or year-over-year calculation, we expect that they'll be stronger. If we were to just take those pandemic-affected prices, assume they go back to where they were over the next 12 months. So assume they go back to where they were pre-virus over the next 12 months. And then everything else, every other category of inflation were to run at 2%, then you would see the dashed line here shows what would happen to headline CPI and core CPI. Headline CPI would be up to almost 3.5%. Core CPI would be up to almost 2.5%. So that's even without anything even running above 2%, you have much higher inflation readings. So from a technical standpoint, yes, we are going to see higher CPI readings. We expect to see some 3% readings. We won't be alarmed by that. What we'll be alarmed by is if we start to see broad-based inflation pressures at the core level that are above this level, this projection. Now the two more substantial concerns. Number one would be the disruption in the supply chain. You can see the disruption in the supply chain in supplier deliveries. That's shown in the light blue line here, and then the prices paid index from the ISM. And I would highlight that this is a very different situation than most cycles. Today, supplier deliveries aren't slow. So as that light blue line moves up, that means deliveries are slowing down. They're not slowing down because we've reached capacity. They're slowing down because of restrictions that are in place, whether it's in the US or in some country that's part of the global manufacturing or global supply chain. There are disruptions there, and that is slowing down deliveries. We expect that will be resolved as the health situation improves, and as it does, we think that supplier deliveries will begin to, or the global supply chain will be healed, and you'll start to see this come back down. We expect the same thing with the prices paid portion of the indices here. The reason we believe that is because there has been, over the past 30 years, a dramatic change in the way goods are produced. And this chart shows really one of our key indicators for inflation historically. This shows average hourly earnings in the gold line. That historically has had its tight correlation with inflation. You can see core goods inflation in the dark blue line, and you can see how in the 70s and 80s, as earnings went, so went core goods inflation, and so went core inflation, core CPI. That broke in the 1990s. As the global supply chain became more and more efficient, you can see how goods inflation has averaged 0.1% year over year from 1995 until current. So during that time, average hourly earnings have been running at a rate closer to 3.5%. So while earnings have been, fairly modest, core goods inflation has been negligible, and we attribute that to the global supply chain, the efficiency of the global supply chain. You can see that this correlates exactly with the increase in the U.S. trade deficit. So what happens today is, as earnings go up in one region, production of a product moves to another region. We saw that in part during the tariff war with China, where production would move from country to country of various products. It didn't move completely, but certainly you saw that occur, and so we expect now that if there's not as much of a correlation today between earnings and goods inflation, I think because of the efficiency that exists in the global supply chain. That is, to us, the long-term global disinflationary environment that once we get through the virus, it will resume, it will take back over control of inflation pressure. The last thing I would highlight is, what is different today than 1970s? That's obviously our concern, that's our fear. And you can see money supply has shot higher. This obviously is at face value, this is a big concern. It really is a concern. It raises the risk to inflation for sure. But money supply has shot higher, similar to what it did in the 70s. Over on the right-hand side, you can see it's up 25.8% today. And you can see how money supply jumped back in the 70s as well. Today, you can see that money supply is up 90% as a percent of GDP, up to 90% as a percent of GDP. This makes it look even worse than it did in the 70s. The other thing I would highlight, though, is that this increase in money supply, and this is as the Fed's been growing its balance sheet, this has really been occurring going back to the late 90s. So even at a more rapid rate than we saw in the 70s. So as money supply alone isn't sufficient to drive up inflation, it has to have other factors involved. One of those factors is the velocity of money. And again, because of time, I'm not going to go into all the details of this, but velocity of money is effectively how many times it turns over, how many times the money supply turns over in an economic system over the course of a year. So if your money supply is X and that money supply turns over 3 times, well, you would then take that velocity times the money supply, and that would equal your GDP. During the 70s, when money supply was increasing, you see that velocity held fairly steady and actually started to increase. We're in a different environment today. As money supply has been increasing since the late 90s, velocity, the number of times it turns over, has been decreasing. This is consistent with an aging population, with a developed economy. It is disinflationary in nature. And you can see how, as this has occurred, as the growth of money supply has occurred, as velocity has trended lower, how core CPI has been anchored below 2% over that time frame. So we don't see, we're in a fundamentally different environment today. We have an aging population, and we think that's one of the big long-term factors that will come back to the front once we get through the pandemic situation. The last thing that I'd highlight is the dollar. Coming out of the 70s, the dollar actually fell 33%. This was after the devaluation of the dollar following the end of the Bretton Woods agreement, where the dollar was pegged to gold. That peg was removed. As it did, the dollar fell 33%. That pushed commodity prices up sharply, and so this exacerbated the situation. Today, the dollar is down 5.7%. This is something that we'll be watching on a year-over-year basis. This is something that we'll be watching going forward. If we were to see the dollar start to really devalue, then we'll become more concerned about inflation. Absent that, I would say that our concerns are not as elevated as they might otherwise be. So with all of that as the background, you can see our rate projection. Our expectation is that this rate cycle is lower, more shallow than previous cycles. We expect the 10-year Treasury yield to get back to 2% and then hold in that range. And we expect the first rate hike, you can see down at the bottom, to be at the end of 2022, because we believe the economy is going to be recovering at such a rapid rate. Part of the reason that we expect the 10-year Treasury yield to hold at 2% and not move higher, particularly with such a strong economy, is because central banks have, not just the Fed, but other central banks have inserted themselves so aggressively during the financial crisis and then as also during the COVID pandemic. And because of that, and because they have purchased so many securities from the markets, they are effectively anchoring yields lower. They're holding them lower. And so we don't expect, and it's kind of a distortion from where the fundamental valuation should be. There is a summary of our economic outlook provided here. It walks through all the details of each sector, and then we've also provided the details of our rate forecast and our economic growth forecast here. But for the sake of time, I'm going to go ahead and turn it over to Michael, and I'll be happy to address questions once his section is completed.
Thanks, Craig. Yeah, we're just going to roll right in. We did get some questions in. We'll get to those. Next, let me introduce Michael Erhardt. Michael is a Senior Vice President in the Investment Strategies Group at Vining Sparks IBG. He works closely with the financial institutions on balance sheet and investment portfolio strategies, liquidity management, evaluation of asset liability exposure, and liability and loan pricing. Michael has over 20 years of experience with financial institutions, and he speaks often at industry conferences on the U.S. economy, expectations for interest rates, and relevant investment portfolio strategies. And Michael, give me 1 second. Let me just pass you over the presenter. You should have it.
Okay. I think hopefully everybody can see my screen. Good morning to everybody.
Good morning. Yes, can see your screen.
Okay, excellent. Well, let's get started. What I thought we would do, just like last time, is, with that economic background as a beginning point, let's jump into kind of what's going on your balance sheet in the industry. Talk about what we're seeing in investment portfolios, and then we'll talk a little bit about relative value in the fixed income space. And I've got, like Craig has, we really pack our slides, I think, with really good information. So I might be a little brief on some of these because I do want to allow a few minutes for questions. But again, I think, Erica, you're going to send these out after the webinar. So you'll have a little bit more time to kind of take these in. In terms of interest rates, Craig really did cover this pretty well, but, I think this is probably one of the best things that's happened in the last 6 months for financial institutions, because we have finally gotten a little bit of a sell-off here in the bond market. If you look at this graph, you've got the Fed funds rate depicted and the 2, the 5, and the 10-year Treasury yields. And so just this year, we have seen a run-up in the 10-year of about 70 basis points. When I put these slides together, it was a little bit higher. And more importantly, right in that 5-year part of the curve, and I think that's more important because that's where a lot of your loans, a lot of your investments are targeted. We're up on the 5-year part of the curve about 49 basis points. So a great improvement from last year, where we spent most of the year in the 30 basis point range in the 5-year part of the curve. And I think, just in terms of steepness, 2 things to think about here. With the sell-off, it's happened on the longer end of the curve, and so you've got better opportunities for higher yielding loans, higher yielding investments. And at the same time, with the expectation that the Fed is not going to increase interest rates anytime soon, your cost of funds really ought to be anchored toward the very short end of the curve. And so that spread that we traditionally look at between the 10-year part of the curve and the 2-year part of the curve is as high as it's been since probably late 2015. For the last 5 years, we have had a flat curve, we've had an inverted curve, and we've seen that 2 to 10 spread average about 59 basis points. So we've almost tripled from that level. So that's a much better operating environment for all financial institutions. So I am thinking that that's going to be helpful in terms of some of the margin mitigation or negative impacts on margin that we've seen over the past year. Let's talk about what's going on in your balance sheets. And to no one's surprise here, this is just a reflection of share and deposit growth over the last decade, basically. And you can see the red line is the annualized growth rate of deposits and shares. And last year, was just unbelievable. We have never seen so much liquidity in the system. So shares deposits were up about 21% year over year. I looked at CUNA's forecast yesterday, and I think they're saying that we'll get another 15% increase this year. So just, every credit union I talk to is awash with liquidity. You just can't get it deployed quick enough. So it is, it's growing in terms of cash on your balance sheet. If you look at this chart, this is asset distribution at year end 2020 versus 2019. And what you can see is, cash has basically doubled as a percentage of assets. Investments are up, but only about 3 basis points. And then on the loan side, you are still growing, loans are still growing. I think they're growing at about a 5% annualized rate, but as a percentage of assets and earning assets, they're down significantly because of that higher cash balance. So pretty interesting environment. And, that's not surprisingly, it's led to a reduction in margin. So if we look back over the last several years, we, as an industry, credit unions peaked out right around 319 on margin. They're now down to 282. And again, I think, that rapid descent that we saw last year of, call it 40 basis points, I don't think that's going to happen again based on where the yield curve is and based on what I'm seeing from, projected margins, talking to credit unions that use some of our AL services. We're seeing those projected margins sort of stabilize. I do think you're going to get some compression this year, but it certainly should not be on the same scale as we saw last year. And the yield curve is definitely going to help that. I thought I might update you guys on overall AL positioning, or where most credit unions are. And what I'm showing you on the screen are two things. Those are the two primary interest rate risk measures. And we have a service called Risk Manager, where we do ALM modeling for a number of credit unions. And this is the median profile. So earnings at risk, you can see both at year end last year and the previous year, credit unions were asset sensitive. They're now more asset sensitive. And I think that's largely because all that cash is basically built up on your balance sheet. And so that's, it's a variable rate instrument and reprices 1-to-1 with assumed changes in market rates. So that is adding to the sensitivity toward higher rates. And on the right-hand side, you're going to see your net economic value at risk. So that's price risk across your balance sheet. And you can see the same trend holds true. So you're a little bit more asset sensitive than you were last year. And I think that has to do with the fact that you've had so much of an increase in deposits, and primarily regular shares, maybe to some degree money markets, and then you've basically seen share certificates be stable to declining. So those extra deposits, shares, are really driving that higher sensitivity. And then I thought I would, again, share with you guys, like I did last time, just a little bit about what we're seeing in bond portfolios in the credit union space. And we do bond accounting for about 167 credit unions across the country. The average portfolio size is about 84 million. The median portfolio size is much smaller. It's about 30 million. The book yield at year end was a 143. That's about an 83 basis point contraction from that time, I guess 12/31 of 19. We did fall again this quarter. I just got the first quarter stats, and we were down about, I think it was another 8 basis points during the quarter. So it is moderating, but it's still a challenge. Every cash flow that you get back in the loan book and the investment portfolio, certainly you're probably repricing a little bit lower than where you were. Interestingly, the effective duration of these portfolios, the median effective duration is 216. The average life is about 3 years. If I look at first quarter statistics, though, after rates went back up, a lot of portfolios have started to extend a little bit. Naturally, if you have some mortgage-related product, those are extending a bit. So average life was up about a year. Duration was up from 0.16 to 3.39. So yes, we are seeing a little bit of extension. There's we have so much good information on these bond accounting statistics that quarterly we try to put together basically all these different metrics, and we look at and see we basically look at the highest yielding portfolios and compare those to the bottom yielding portfolios. And on the screen on the left hand side, I've got the top performing as measured in yield, and on the right hand side are the bottom earners. And you can see what some of the metrics look like. The book yield on the highest yielding portfolios right around a 185, and then the book yield for the bottom half, or the bottom quartile, sorry, is at 88 basis points. So quite a disparity between those, but you can see what's going on. The top performing quartiles generally have just a little bit more duration, and they take on a little bit more credit risk in the form of taxable municipals. So if you look at some of the little things I've highlighted there with the circles, the top performers also just have a little bit higher allocation to SBA fixed and municipals, versus the bottom quartile is more about cash flow, less about yields. So and obviously it just depends on your balance sheet on what type of portfolio and products you need to complement everything else that's going on your balance sheet. We have seen yields come way down. This is the same set of data. This is our bond accounting statistics split up in those four quartiles. At the very top of your screen, you'll see the highest yielding portfolios. They kind of peaked out at about a 272. Now they're down to 185. And at the bottom, you can see the bottom quartile peaked out right around a 2% level, and now they're down to 88 basis points. And in the backdrop, you've got the Fed funds and the 5-year Treasury rates and yield there. So everything is coming down, like I said. And in this environment, I put together kind of a quick hit list on how to defend your margin. I think last quarter we talked about this or 6 months ago, and we called it defending profitability. But it's the same concept, and it's going to be the same message that you've heard probably over the last year. But with margins still contracting, it's to eke out some earnings, you've got to be extremely efficient with your balance sheet. So the number one thing on my list would be, if you don't have any organic loan demand, definitely consider loan participations or just buying loans. Vining Sparks has an active loan trading desk, as do other broker dealers across the country. I think they are scraping the bottom of the barrel out there to some degree. I talked to a credit union the other day that told me they were being shown swimming pool loans across the country. So that seems a little bit scary to me. So stick to the things that the best, things like autos, RVs, real estate, NBLs with high credit quality would be my recommendation there. Another thing that you can control and do it very well is the amount of cash that you have on your balance sheet. So that 13% of total assets is really high. We want to try to mitigate that as best as you can and deploy that excess liquidity. And then on the deposit side, the funding side, I looked at the very largest credit union in the Memphis area where I'm from this morning, and they've marked their regular shares down to 1 basis point. Their money markets basically are tiered from about 1 basis point to 20, and then their CDs basically range from about 20 to 65 basis points, depending on the term. So I really think you got to work on that part of the equation as well, and try to get your funding costs down this year. I think cost of funds was sitting at 72 basis points at year end. I think a logical goal for most credit unions would be to get that well below 50 basis points before the end of this year. We do have a couple of slides here on the cost of waiting, and I do want to cover these just quickly. There's a table that basically outlines about 5 different scenarios on where the overnight rate may go. And let's just take that second one on the page, and I want to walk through it real quick. This one basically assumes that overnight rates are going to be flat for 2 years, and then in the third year, the Fed starts increasing rates by 25 basis points. So the analysis here is basically saying, hey, what if we just wait in cash until rates go up before we invest? This is trying to point out how much lost income or opportunity cost that you may incur. And so if we can assume that right now you can go out and buy an investment for 1.25, based on that rate scenario from the Fed, the break-even rate's 31 basis points. And if you look to the far right, investing $20 million today, you're going to pick up an extra $230,000 in year one, year two the same, and year three $105,000 even after Fed funds starts going up. So that break-even rate is 31 basis points. If you buy anything that yields more than 31 basis points, you're going to do better in that scenario versus sitting in funds and waiting on the Fed to move. So I thought this might be helpful, especially if you're talking to other members of your management team and trying to convince them to put money to work. The other one I want to talk to you about quickly is the cost of waiting. This table is just a little bit different. It looks at the required yield that you must get on an investment if you were to wait a few months or up to a year before you put money to work and you leave it in your overnight account. So on the far left-hand side, you've got a current investment. I just used $20 million, again, putting that to work on an incremental basis over the next 12 months. If you look to your right, in the middle of that table, there's a 6-month column that I've highlighted. So right now, a 125 investment yield is probably pretty achievable. If you put that to work immediately, you're going to make somewhere in the neighborhood of $230,000 on an annualized basis, above and beyond what you would in Fed funds. Well, if you wait 6 months before you put it to work, you've got to get a 2.3% investment rate to make that same $230,000 annualized amount of earnings. And so this is a great example of just how punitive it is to sort of wait and wait for yields to go up. I'm going to take another three minutes or so we'll have like 5 minutes for questions. But I want to run through the fixed income market and just kind of tell you what we're seeing out there. In terms of agency bullets, spreads are extremely thin. You are almost better off just buying a U.S. Treasury versus an agency bullets. The 3-year spread and the 5-year spread are both 1 basis point. So again, those are good sell candidates, or just opt for a Treasury because you're not getting paid for the extra credit risk. The callable side of agencies looks a little bit better. And if I've highlighted 2 things on this page, I would focus on the 3 to 5 year part of the curve, and I would try to get 1 to 2 years of lockout. The last thing we want to do is go back to what happened in 2020 when you had all that cash flow being called back. So I want locked out cash flows this time that can't get away from us over the next year or so. I would probably target a 1 or 2 year lockout. There's another sector that a lot of credit unions are going to, and that's agency CMBS and then fixed rate SBA pools. I've highlighted just this table. You've got it broken out, basically a 5-year, 7-year, 10-year kind of horizon. And then you've got the spreads to treasuries. And the couple things that I've highlighted are really in that 7-year part of the curve: DUS bonds, DCPC, which is an SBA, and then SBIC, which is another SBA product. You can see those spreads. They're not great, but they give you at least some decent levels of spread above and beyond an agency bullet. So think of these things as an alternative to agency bullets. So I do think there's some value there. In the mortgage sector, spreads are extremely tight, and it's just because of the Fed. They're buying, probably $28 to $30 billion per week in mortgage-backed securities. So they have driven the price up, the spreads lower. The good news is, if you look at actual offerings, I've got on the screen, I've got 4 offerings. These are recent, and they're all 1.5% coupons. At the very bottom of your page, you can see a base case yield. These are tiny. I know you're probably, if you're like me, your eyes are squinting, but if you look at a 20-year 1.5, we're talking about a 160 projected yield versus at the beginning of December last year, you were talking about 80 basis points of projected yield. So yes, spreads are tight, but the absolute levels of projected yield look good. There's also other options, CMO options with cut down coupons. I've got one highlighted on the screen where you can get at a discount. So if you're still scared about paying or nervous about paying a premium, the CMO space with stripped down coupons off of like 15-year collateral looks very good. The other thing I would tell you is taxable munis are extremely expensive right now. If you look at the bottom of the screen, that's just a kind of a historical comparison of where those spreads are. Those are extremely tight. So I might stay away from that space at this point because a 5-year taxable muni yielding 17 basis points more than a treasury doesn't seem like fair compensation to me. So good sale candidates if you own them and you need to harvest gains. The other thing, I'll make a pitch. I'm willing to do anything I can to help you guys. We have a great set of tools that we can use to model bond swaps, loan additions, term funding additions. It's called the Performance Architect. So I'm glad to run that for you guys, absolutely free of charge, and give you an indication of types of things that you guys can be doing in terms of strategies. So to summarize, and I'm sorry we're taking a little bit long here, I think it's just extremely critical to be as efficient as you possibly can this year, and that means you've got some stress out there. Thankfully, it's not the loan book, but it's just basically margin contraction. So there's some things you can do, like we talked about, basically deploying excess cash, thinking about loan participations, being very careful to make sure you're not overpaying for money because money is so cheap at this point. And then having a mix of mortgage-backed securities and maybe some of those things that I mentioned, like CMBS positions that are more positively convexed. A good mixture of those two products will probably be your best bet this year for the foreseeable future. So with that, I'm going to turn it back over to Erica, and I think we have a few more minutes left for questions.
Yeah, thank you, Michael. And yes, we have some time. Craig, this one would be for you. Which of your macro variable forecasts, GDP, inflation, interest rates, do you have the most confidence in? And what about the least confidence in?
Wow, that's tough. I'd say we have probably the most confidence in our forecast that we have the most confidence in our forecast that growth is going to accelerate at a rapid rate. We have strong confidence in or good confidence in our expectation for job growth, that it will recover at a fairly rapid rate this year. We think there will still be some residual loss, but we think that it should recover at a fairly rapid rate. I would say that it's hard to identify a specific sector that we have less confidence in. We feel strongly about the consumer. We feel strongly about the housing market. There will be less tailwinds going forward, but we still feel pretty confident about the housing. We feel good about business investment. We feel strongly about imports, a little bit less strongly about exports. And I'd say overall, there is a high degree of uncertainty when it comes to, most economists were trying to determine if growth is going to be 2.3 or 2.4% in a quarter. And so we're working with fairly sharpened pencils. In today's environment, I'd say if we're within 1% of being right, we'll feel like it's a success. So I'd say there is a high degree of uncertainty that attends our forecast today, but we do have a high level of confidence that things are going to accelerate.
Do you think that on a global level, the worst economic damage is behind us at this point?
I do, yes. I think the rates of recovery will be different. In the U.S., it's going to be, we're in the throes of the more rapid recovery. It'll be a little bit delayed in Europe. Asia is recovering. They'll be largely dependent on what happens in the U.S. and Europe.
Michael, this one is going to be for you. How do you think credit union deposits will behave over the next 12 months as employment prospects or job security improve for members? How quickly will they withdraw shares from share draft and MMDA accounts?
That's a great question. I wish I had a crystal ball and I could give you an estimate. But if I were you, if I were managing a balance sheet, I would bank on a little bit of a pullback of deposits in the second half of the year. I've heard a lot of industry experts say that the deposits will stay in the system. If you're a consumer, you're going to go spend your money at Walmart or Target or wherever, and that money is going to stay in the financial system. But I think smaller institutions will see a little bit of a bleed out because Walmart, Target, they don't bank with community-based financial institutions. So yeah, I think deposits are pretty sticky overall. But I would bank on some type of contraction. Just call it maybe 5% in the third and fourth quarters.
And staying kind of with you, Michael, what types of loan participations and whole loan purchases are you recommending presently?
Yeah, I think what we have sold the most of are your typical auto pools, RV pools. We've done a few solar panel pools. We've done some real estate, CRE. We've done MBLs. And so those are the things that, I'm comfortable with because they seem to be things that most credit unions do. So I would stick with those types of things that you know best, and how to underwrite those types of products.
Okay, and I think, what kind of assumption do you make about the stock market in your forecast, especially future consumption and the wealth effect? I think that's to you, Craig.
Yep. So the wealth effect has become less reliable of an indicator over the past 10 years than it was historically. As the Fed has created financial liquidity, it has benefited one share of the consumer population more than it has others, and tends to be a group that doesn't spend as quickly. And so the wealth effect has the correlation between wealth effect and consumption has been lower. We do expect stocks to continue to be positive. We don't have a specific. We actually use our stock forecast is actually and we don't provide an exogenous input for that, so we don't make an actual forecast. It's actually the result, so it's an endogenous variable in our models. But our assumption is that it'll continue to be strong because you'll have so much liquidity, you'll have rapid rates of recovery, and we don't think yields are going to move up high enough to change PEs. Now that eventually, if rates continue to rise, then we would expect to see PEs start to be challenged, but in the short term, we don't expect that to be the case.
Okay, and it looks like our last question is kind of general, but is there anything that has surprised you over the past year as an economist?
Yes, the election results surprised us. We expected there to be divided governance, and we expected very little to get done over the next 2 years. That amount of stimulus has changed our forecast dramatically. How quickly vaccines have been developed and distributed has been a surprise as well.
Great. Well, that's everyone. Oh, hang on a second. Nope, I think we just had one more come in. Sorry. Hang on. Give me 1 second. Oh, no, that was just a comment. They said one of our CEOs commented, know your niche, great advice, stick to what you do, best for small credit unions. So just a compliment. And yeah, thank you both for being here today. We're going to conclude today's presentation. Craig and Michael, thanks so much. I know you packed a lot in a short amount of time, and we really appreciate it. It was everyone will be provided the copies of the presentation decks, and also the recording of today's webinar will be available. I'll let you know when that is ready to view. And Craig and Michael's contact info can be found on their presentations, but you can also reach out to me, and I'm happy to provide that to you. And again, Craig and Michael, thank you so much. Thank you, for your time and for these great presentations.
Well, thanks for having us.
Yep, we appreciate it.
And thanks for coming today, everyone. Take care. All right, that does it.